but it's ended always in a massive devaluation. And that's why I'm against it. I think it's a bad precedent, and I think it will not work. And I don't think the BRICS countries or emerging economies will let themselves be blackmailed because the US dollar is not all that important anymore in the trading of goods. In the trading of capital, it's still a huge thing, the dollar, still the dominant currency in the world and the dominant component of foreign exchange reserves. But for trade, you have much more trade essentially between China and then emerging economies that is carried out outside of the US dollar. So I think that these are desperate measures that will actually backfire against the US. Maybe some neocons in the US will think that they have the power. In my view, they don't have the power anymore, and it will be perceived as a very negative measure. I suspect that most emerging economies have a relatively negative view about Western dominance. The dominance manifested itself first in the colonies since the 17th century, in essence, and more lately in trade and in institutions such as the UN and so forth. So my view would be actually that the Western world, the so-called developed world, would do well to be more concerned about emerging economies, and in particular the BRICS bloc, and not provoke them. That would be my view. I mean, some countries will not keep all their money in US dollars because they've seen how the US can seize assets. They don't want this to happen again to them. So they're moving out of US dollars. But a large portion will still stay in US dollars. But these dollars may be anywhere. They may be in London. These are London dollars or Euro dollars, as we call them. Right. And some dollars may be in the US. So actually, to tell you the truth, we don't know exactly what will happen. And in this environment, I think that large or important decisions may be postponed. The tariff ideas, to start with, is a very bad idea. But some people will disagree with this. But in general, countries that have imposed high tariffs, they have a higher level of prices domestically and are less competitive globally. So my view would be to avoid tariffs at all costs. But this is not the view of many economists in the United States. They think the US is sort of giving away some things to emerging economies, when in fact the US has benefited from global trade, and especially from the weapons trade. They benefited a lot by selling by creating problems around the world and then selling weapons to these impoverished countries. I've seen many countries, they had dual currencies. They had a financial dollar and a trade dollar, and the trade dollar was lower, so they remained relatively competitive in trade and artificially high in financial assets. But usually the countries that have had this dual currency currencies, and you can look it up in Wikipedia, Wikipedia, what it exactly is. But it's ended always in a massive devaluation. And that's why I'm against it. I've just written a report and I say the Trump top. Since July, I've been arguing that we are at major turning points in asset markets. We have to distinguish the consumer goods inflation and inflation for services and the inflation of assets. The inflation for assets is usually called a bull market. So in other words, when real estate prices go ballistic, people call it a rise in home prices. They don't call it an inflation in home prices. But the cause of rising home prices is the same as the cause of rising coffee prices. It's too much money printing and too many fiscal deficits by countries. In other words, the countries, they spend too much. They print money and they give it to their citizenship. And as a result of that, the citizenship, the people can buy goods and services and assets, but the debt level of the government increases, therefore. And this is not a sustainable economic policy, in my view. Now, some people dispute that. They say, oh, government debt doesn't matter, it just goes up and so forth. But no, it matters because the interest payments on the debt also goes up. And eventually the interest payments on the debt is more than all the other expenditures combined. But in the meantime, people say, okay, it's okay. And the Wall Street loves rising asset prices. They will never argue against rising asset prices because Wall Street lives from rising asset prices, because the more money there is in the system, the higher the fees are that Wall Street can collect from the innocent public and the naive public that believes that the government should intervene, that the government should spend money. Whatever the government touches is a disaster, has been proven in every country.
Amen.
Well, I wouldn't know because, and my view is, of course, very negative about the US dollar. It doesn't mean that the US dollar can't go up for another week or two or even a year. But I'm just suggesting to you that in the long run, the US dollar will be like the British pound. Its value, its purchasing power, to be specific, will diminish. Currency has lost purchasing power over the last 80 to 100 years, but massively so. The dollar today doesn't buy the same goods that the dollar bought 50 years ago. Just when you walk by an antique shop or, junk stuff market, try to find a menu of McDonald's of the years 1960, 1970. Since then, the value of paper money has diminished enormously. If I had assets in 1970 and I was concerned about the depreciation in the purchasing power of paper money, I could have bought gold at $35 an ounce, okay, in 1970. Now it's 2,000, whatever, 2,700 or so. Or I could have put $100 or $1,000 or $1 million on deposit. And every year, the interest on the deposit in the 70s went up, and in the 80s and 90s, and until recently, it went down. But say, if I just earned 5% per annum compound, it's a higher return. Yeah. With an ounce of gold, I can buy actually today more hamburgers than in 1960.
Summary. Marc Faber provides a stark analysis of the emerging global economic tensions, particularly focusing on the potential for currency wars driven by aggressive tariff policies and economic manipulation. He argues that the United States is risking significant international backlash by attempting to use economic sanctions and tariffs as a tool of geopolitical control. Faber warns that emerging economies, especially the BRICS nations, are increasingly developing mechanisms to circumvent U.S. dollar dominance, viewing such actions as a form of economic blackmail that could precipitate a dangerous cycle of currency devaluation and retaliatory economic measures. The Economist critically examines how protectionist policies and tariffs invariably lead to negative economic consequences, highlighting that countries implementing high tariffs typically experience increased domestic prices and reduced global competitiveness. Faber suggests that these policies are fundamentally unsustainable, often resulting in dual currency systems that ultimately end in massive currency devaluation. He points out the historical pattern where attempts to artificially manipulate currency valuations through financial interventions have consistently resulted in economic instability, with countries finding themselves trapped in increasingly precarious financial positions. Faber's analysis extends to the broader implications of these economic tensions, warning of a potential systemic shift in global economic power. He argues that the continuous printing of money, implementation of tariffs, and attempts to control economic narratives will likely backfire, causing a gradual erosion of U.S. economic influence. The Economist emphasizes that emerging economies are increasingly aware of Western economic manipulation and are actively seeking alternatives to U.S. dollar-dominated trade systems. This potential currency war, according to Faber, could fundamentally reshape global economic relationships, with long-term consequences that extend far beyond immediate trade disputes, ultimately threatening the purchasing power and global standing of traditional economic powers.